Stop looking at the old support lines. They are gone, obliterated, completely useless. Sterling is currently trading at 1.3325, and this is not a drill. While retail traders are trying to catch a falling knife, the institutions are pricing in a full-blown UK political risk premium that hasn't been seen this aggressive in years. There is one danger zone today, a deep value trap sitting around the 1.3300 round number, and one hidden opportunity that only triggers when the liquidity void gets filled below 1.3200. I will show you both setups right now, including the exact level where the dead cat bounce must fail, and the precise stop placement that keeps you safe when the algos start hunting. Stay until the end because I am giving out 3 precise entry and exit levels you can set as alerts immediately. The session bias is clear, non-negotiable, trending bearish with extreme momentum. The daily candle today reads a strong sell, and the 5-hour momentum is not lagging behind. It is leading the charge lower, confirming that lower timeframe scalpers and higher timeframe macro funds are perfectly aligned in their distribution. The one invalidation level that proves this entire bearish thesis wrong, the line in the sand where I will admit defeat and flip my bias instantly, is the structural breakdown point we just violated. Write this number down right now in the comments. Your bias flip number for the next 48 hours is 1.3486. If, and only if, buyers manage to reclaim 1.3486 on a daily close, the bearish structure is compromised, and we move back into a recovery phase. But as long as we remain below that magnet, this is a sell rallies market. No exceptions. Let's walk through the screen together, top down, because the chart is screaming institutional distribution right now. Starting on the weekly time frame, we have just printed a massive bearish engulfing candle that has swallowed 3 weeks of previous price action. This is not a gentle correction. This is a wrecking ball. The price sliced through the 20-period moving average on the weekly chart like it was wet tissue paper, and that moving average now stands as dynamic resistance. The MACD on the weekly is now crossing into a sell signal, with the histogram flipping deeply negative, confirming that the momentum is accelerating, not fading. Zooming into the daily chart, here is what most traders are missing today. We had a textbook double top structure with the peak sitting just above the 1.3850 handle, and the neckline of that structure was firmly established at the 1.3400 psychological and structural zone. That neckline has been completely incinerated. The measured move target of this double top, if we calculate the height of the pattern from peak to neckline, points directly to the 1.2950 area. But we do not need to get that far ahead yet because there is a more immediate liquidity void that acts as a magnet. The 200-day moving average is sitting much lower, but the immediate support that matters right now is the 1.3294 level, followed by the massive monthly support pivot at 1.3198. Those two numbers are your destination targets for the current impulse wave. The daily MACD is buried in negative territory, with no sign of a bullish divergence. The histogram bars are extending lower, which tells us the selling pressure is accelerating, not exhausting. Here is what the moving averages are doing on the daily chart. The 20-day MA has crossed below the 60-day MA, forming a classic death cross. The 60-day is now starting to roll over. The price is currently trading below all major daily moving averages, which means any rally attempt will find overhead supply stacked like a wall. The nearest resistance on the daily is that former neckline at 1.3400, which now aligns perfectly with the 20-day moving average. That 1.3400 to 1.3486 zone is your sell zone. This is the area where short sellers will be reloading with confidence. Drop down to the 5-hour execution time frame, the chart that dictates your entry timing. We are in a textbook waterfall decline. The 20-period moving average on the 5-hour chart is acting as a perfect dynamic ceiling, currently pressing down on price. The MACD on the 5-hour is deeply oversold, which is the only caution flag right now. Being deeply oversold does not mean buy, it means the trend is incredibly strong to the downside, and we should expect only shallow, short covering bounces before the next leg lower. The moving averages on the 5-hour are in perfect bearish alignment. The 20 is below the 60, the 60 is below the 200, and the price is pinned below all of them. Until the 5-hour 20-period MA is recaptured, do not even think about a bullish swing trade. Crosser set confirmation is flashing the same warning. The US dollar index is surging, breaking above key resistance levels, which acts as a headwind for all dollar-denominated pairs. But this is not just a dollar strength story. Look at euro to pound sterling. The cross is surging higher, which means the pound is losing ground against the euro simultaneously. This confirms that the weakness is pound-specific, driven by the domestic crisis, not just a broad dollar rally. The UK gilt yields are spiking on the short end, which usually supports a currency, but in a fiscal credibility crisis, higher yields driven by fear become a negative feedback loop. That is the rare macro fracture we are witnessing. Yesterday's news cycle was a wrecking ball for sterling, and it has nothing to do with the traditional Bank of England rate path right now. We have a UK fiscal credibility gap that has exploded into the open. The markets are rattled by a severe crisis of confidence in the current administration's spending plans, and the bond vigilantes are back in full force. When a government's fiscal math gets questioned so aggressively that the bond market starts demanding a significant risk premium, the currency becomes the release valve. That is exactly why sterling is collapsing while the euro is relatively stable. This is a localized UK sovereign credibility shock. Here is the cross-linkage with the euro that confirms the thesis. Euro to pound sterling is ripping higher, breaking through key structural levels. This means the market is explicitly shorting the pound as an independent trade, not just buying the dollar. If this were a pure dollar strength event, euro to pound sterling would be flat or falling. The fact that it is surging tells you that the smart money is isolating sterling weakness. So when you are shorting cable today, you are not fading an overbought market, you are participating in a capital flight event. For the 1 to 2 week directional lean, we are targeting a full test of the 1.3198 monthly support as the base case, with an extension towards 1.3100 if that support fails to hold. The fundamental trigger that could slow this decline would be an emergency verbal intervention from the Bank of England or a fiscal policy U-turn from the government. Without that, the path of least resistance remains down. The exact event that invalidates the aggressive short thesis is a daily close above 1.3486 combined with a sharp reversal in UK gilt yields. Until then, buy dips on the dollar and sell rallies on sterling. Most people will click away right before the most profitable segment of this video, but this is exactly where money is made. Keep watching because I am handing you the exact trigger prices, stop distances, and take profit scaling levels that define professional risk management. Strategy 1. The sniper. The conservative retest short. This is the highest probability setup for the patient trader. We are waiting for the inevitable short covering bounce that will come from the deeply oversold 5-hour momentum. Do not chase the breakdown here. Wait for the price to retrace into the resistance zone between 1.3390 and 1.3405. This zone is the perfect storm of resistance, the psychological number, the broken neckline of the double top pattern, and the pressing 5-hour 60-period moving average. The activation trigger for this trade is a 5-hour candle close below 1.3380 after the zone has been tested, or a clear bearish engulfing pattern on the 15-minute chart at the 1.3400 resistance. Your stop loss goes at 1.3450, which sits above the recent swing high and clears the noise. Your first take profit target is the support at 1.3295, giving you a solid risk-to-reward ratio. Your second target, where you scale out the remaining position, is the liquidity pool at 1.3210. This setup gets voided immediately if the price closes above 1.3486 on a daily basis. Strategy 2. The active trader, the momentum breakdown. This is for the trader who sees the acceleration and refuses to miss the move. The entry condition here is a clean breakdown and 15-minute candle close below the intraday support at 1.3280. We are not waiting for a deep retracement. We are accepting the immediate follow-through momentum. You trigger your short on the break of 1.3280 with a stop loss placed at 1.3335, just above the current intraday resistance cluster. The logic for the stop is simple. If the market reclaims 1.3335, the immediate acceleration has failed, and you are wrong. Your first target is 1.3200, capturing the big figure 8. Once 1.3200 is tested, move your stop to break even. Your second target is the 1.3125 extension level. The risk to reward on this setup is aggressive, but it aligns with the velocity of the current move. Let's see how aligned we are as a trading community right now. Type your pound sterling to US dollar 24-hour range prediction in the comments below. Where is the high? Where is the low? I am reading them during the intermission, and I want to see who has the best read on this volatility. Strategy 3. The aggressor, the liquidation wicket scalp. This is the high-risk, left-side trade for the adrenaline junkies who understand that the biggest countertrend bounces come from the deepest pain. The only level where I would consider a countertrend long is a sharp, panic spike into the 1.3160 to 1.3180 zone. The activation condition is strict. We need a massive pin bar or a bullish engulfing candle on the 15-minute chart precisely at the 1.3180 monthly support, followed by an immediate recovery back above 1.3200. You buy the reclaim of 1.3205 with a microscopic stop loss at 1.3150, just below the liquidity sweep low. Your first target is a quick 1.3270, and the second target is 1.3320. This is exclusively for those who know how to lose small and manage risk on a hair. Trigger. Do not marry this trade. If the bounce does not materialize within two 15-minute candles, you are out. Do not let a single trade define your week. Never risk more than 1 to 2% of your account on any single sterling trade right now because the volatility expansion is off the charts. No open positions through the London fix or any surprise BOE speaker headlines. Stops are non-negotiable. Liquidity gaps will hunt your mental stops, so hard stops only. The most critical level to watch for the next session is 1.3294. If we lose that on a closing basis with no bounce, the 1.3198 support becomes the immediate magnet, and we likely test it within 24 hours. Tomorrow, we are focusing on the US dollar to Japanese yen and Nikkei 225 cross confirmation, as the yen intervention ghost is back in the room, creating a massive divergence you need to see. If you want the full breakdown of that intervention risk setup and how it affects every dollar pair, that video is live on the channel right now. Click the end screen to jump to that analysis. Smash like if this gave you a clear, unemotional trading plan for today's chaos. Subscribe and hit the bell for daily institutional coverage. The market doesn't wait, and neither should you. See you in the next session.